Let's move on to this matter now. On Wednesday, Finance Minister Enoch Godongwana delivered his second midterm budget. Now, despite severe economic constraints driven by power cuts and rocketing food and fuel prices, as well as a looming global recession, government's debt burden looks more stable. To discuss this further, we are joined by Waldo Marcus from the TPN Credit Bureau. Thank you for joining us this morning, Waldo. Before we get into specifics around what was mentioned by the Minister, your general overview of what he delivered on Wednesday in terms of what the budget looked like this year and potentially what we could be seeing in terms of the national budget next year.
Good morning, Rafiel, and to your viewers. Yes, I think the Finance Minister tried to make the best of a situation. It was really difficult to balance things out. To his benefit, SARS have improved its collections. And it's better than expected with 85 billion higher collections, which comes from both private sector as well as PAYE. We've seen that the finance sector as well as manufacturing has pushed up tax collections. And then, of course, SARS also improved its tax collections, which then contributed to this 85 billion rand that they have more than anticipated. But overall, the economy is going through an extremely tough time. Some of it due to structure and our state-owned enterprises. And then there's also, of course, the global economy, which is heading into a recession. We've got energy crises in the Northern Hemisphere. And of course, that impacts the South African economy. And we can see it in just our inflation. And of course, with inflation, one of the few levers we do have, we rely heavily on the Reserve Bank to bring this down. And of course, one of the instruments they have, and they've been used aggressively so far, is of course the repo and interest rates. That in turn has put huge burden on the consumers, which again is needed for this economy just to start picking up, starting to need to show the growth that we are so desperately needing right now.
One of the sectors, and I can assure you and our viewers, Waldo, that almost every single sector has been impacted by this economic downturn, not just in South Africa, but globally. The property sector, commercial and residential. So I suppose when the SARB initiated the interest rate cutting cycle to alleviate some of the pressures on the consumer, there was somewhat of a boom. And I just want to get a sense from you what's happened, and really just what came out on Wednesday from the Minister has had an impact on both residential and commercial property sectors.
So let's break it up and look at the commercial property sector. The commercial property sector, which includes retail, industrial, storage, and the office sector, has really struggled to recover after COVID, and there's various reasons for it. But interesting that what we see in the TPN data is that the lower rental brackets within the commercial property sector is struggling to recover, and they are not collecting rental as previous prior to COVID. The below 10,000 is sitting roughly around about 66% in good standing, and good standing, according to TPN, is tenants that paid their rental in full. Therefore, they've made their rental commitments by the end of the month. Now, in contrast, the highest rental bracket, which is the 50,000 or more, so therefore the bigger businesses, their good standing is just under 80%. So we can definitely see that the smaller businesses are really struggling. And of course, those smaller businesses have less access to capital as well as cash to keep the lights on. And most of these businesses rely on a consistent and sustainable power supply to run businesses like bakeries and welding facilities, manufacturing plants. The bigger businesses, of course, with access to capital and with access to enough cash flow to keep, to purchase the diesel to keep the lights on, we are seeing that they are positively impacted. If we look now at the residential rental market or the consumers, there we've seen much better performance, and there's two reasons for that. The higher inflation rate normally improves demand for rental properties as people hold back around uncertainty. We kind of expecting the interest rate to kind of hit a low road around 11%, high road about 12% before it stabilizes really. And that, of course, will have a huge impact on the demand for purchasing property. Coming back to rental property, the demand increases. And we've actually seen that in our vacancies, which has dropped consecutively since COVID. We are now sitting just over 6%. Comparing to during COVID, we were sitting at 13% vacancies in the residential rental market. The positive about this is that the people and the consumers are still committed to making payments towards their rental accommodation. Once again, the lower end of the market, those paying less than 3%, is still struggling to make up, and they are still below the 70% mark. However, the 7,000 to 12,000 rand rental bracket, so those kind of spending 7,000 to 12,000 a month on rental, they're sitting at 88%. So you can see there's a big difference between the two. This, of course, is showing that people are committed to doing so, but of course, it's also still very early days, understanding that we have had negative growth in this quarter from a GDP, or previous quarter from the GDP, and we are looking forward to seeing what is coming out in the next quarter in terms of growth, as this will give us a very good indication of where the economy is going and how much additional strain there will be on the consumer.
Now, given that mixed bag that you've just described for us, both in the commercial and residential property space, would it still be a viable investment option for a South African?
Well, there's, of course, there's a yes and a no. There's not a clear answer to that. There's definitely pockets in South Africa that property is performing very, very well. We are seeing that, for instance, the Western Cape is showing great growth in terms of capital, low vacancies, good rental income coming through. And then there's smaller towns that's really struggling. People are not making the returns on investments as they would. So it's a very difficult question to say, is it still a good investment? There's a yes and there's a no. There's a positive case for it. I think what one needs to understand is that developers and those relying on heavy gearing with banks, it's becoming more and more expensive to pay back the interest. Capital is a lot more expensive. So we're expecting to see a slowdown in the new properties coming online, both commercial and residential. And therefore, the opposite is that there's a higher demand, and higher demand for these properties, because there's less supply, drives up the prices, reduce the vacancies, and of course that in turn helps people make returns. So it really depends on where you are in the cycle. But overall, I think that a lot of people are holding back. They know that we're going through high inflation. We've seen food prices skyrocketing. The rand-dollar exchange, the rand has strengthened a little bit after the minister delivered his budget speech. And then that in turn, of course, impacts something as the fuel price, which in our economy drives a lot of our inflation at the end of the day.
Thank you very much for those insights, Waldo. And that is Waldo Marcus from TPN Credit Bureau there, just breaking down his understanding of the midterm budget policy statement and the implications thereof on sectors like the property sector.